You know the story, right? A tech revolution comes along promising to change literally everything. The markets go wild, money is flying everywhere, and in 2025, that revolution is artificial intelligence. But here's the big question. Is this a real, solid economic transformation, or is it just a massive bubble, inflated on a foundation that's, well, dangerously fragile? Today, we're going to dig into the 2025 AI boom and figure out if we're looking at a miracle or a system that's teetering right on the edge.
So, let's kick things off with a warning shot that was fired way back at the start of the year. On January 3rd, Phil Davis from philstockworld.com basically laid it all out. He pointed out that big tech was dumping hundreds of billions into AI and said, if that doesn't pay off, it will be an economic mistake that makes the dot-com crash look like a pothole. Whoa. That single quote really sets the stage for everything we're about to look at. Is this the best investment ever, or a gamble of historic proportions?
All right, to really wrap your head around what's happening, you have to realize that in 2025, we're not dealing with just one economy. It's really two. You've got this incredible concentration of wealth and power happening at the very, very top, and then there's a totally different story for, everyone else. So let's start where the money's at, the stock market.
Let's just start with one number, just one, 39.3%. That is how much of the entire S&P 500's value is held by just 10 companies. 10. To put that in perspective, that level of concentration is way higher than anything we saw even at the absolute peak of the dot-com bubble. This isn't a market that's just being led by a few giants anymore. For all intents and purposes, these giants are the market.
And check this out. This slide really puts it in black and white. On the left, you've got the year 2000, the poster child for a top-heavy market, right? Back then, the top 10 companies were about 26% of the S&P 500. Now look at 2025 on the right. That number has exploded to 39.3%. This isn't some small shift. It's a complete reshaping of the market, and it's almost all being driven by this AI build-out.
And here's the thing. This crazy imbalance isn't just some abstract thing happening with stocks. It's hitting the real world hard. According to Moody's, the top 10% of the wealthiest households now account for almost half, 49.7% of all consumer spending in the country. Think about that. The entire economic engine is now almost completely dependent on the spending habits of a tiny, wealthy slice of the population.
And that brings us to the other economy, the much, much bigger one. Because while the top is flying high on stock gains and AI hype, the foundation, the other 90% of us, is showing some really deep, really worrying cracks.
And this isn't just a vibe. The data from 2025 tells a pretty brutal story. Back in March, consumer confidence just plummeted to crisis levels. By August, as savings vanished, credit card debt just exploded past $1.2 trillion. Then in September, you had stores like Dollar Tree waving a giant red flag, saying their customers, the bottom 80%, are totally tapped out. And by October, new borrowing just slammed on the brakes. This is not a slowdown, it's a full-on stall.
And this chart? Wow, it really shows you the stress people are under. This is the percentage of credit card debt that's seriously delinquent. We're talking 60 days or more past due. After hitting a crazy low right after all the stimulus, it has now shot up to its highest level since the 2008 financial crisis. People aren't just using credit cards to get by anymore. They're starting to not be able to pay them back.
And this all boils down to what Phil Davis said back in August. We can't have sustainable capitalism where 80% of the population gets progressively poorer while 20% gets progressively richer. You just can't. It's a fundamentally unstable system, which leads to the big flashing question. If the average person is completely broke, who the heck is funding this trillion-dollar AI party?
Okay, so this is where we get to the core of the problem. If the regular consumer is out of money, where are these mind-blowing revenues coming from that justify these insane AI stock prices? Well, the answer, it's a little weird, and it kind of points to a major flaw in the whole system's logic.
So let's just ask it straight up. Where is all this AI money really coming from? If it's not from a huge base of customers buying things, what is actually fueling this incredible boom?
The answer, at least according to a growing number of analysts, is something they've bluntly called the Great Tech Circle Jerk. I know, it's a crude term, but it perfectly captures the circular flow of money where big tech is basically creating its own customers. They're making revenues look way, way bigger and more real than they might actually be.
Here's the playbook, step by step. Step 1, a giant like NVIDIA invests a few billion in an AI startup. Step 2, that same startup immediately turns around and uses that money to buy billions of dollars in chips or cloud services from NVIDIA. Step 3, NVIDIA reports monster AI revenue, which of course sends its stock to the moon. And Step 4, the startup's valuation gets a huge boost, making the first investment look brilliant. See, it's a perfect, self-contained loop that prints incredible numbers on paper.
And as you can see here, this isn't some theoretical idea. It's happening all over the place. Microsoft invests a ton in OpenAI, which then becomes a gigantic customer for Microsoft's cloud. Amazon plows billions into Anthropic, which then runs on Amazon's cloud. And NVIDIA, the center of it all, invested in CoreWeave, which then turns around and rents NVIDIA's chips to other companies that NVIDIA also invested in. It's a tangled web of deals holding this whole thing up.
And all of this deep financial entanglement, brings us to the final and, frankly, the most serious part of this whole story. The danger here isn't just that a few tech stocks might be overvalued. The real risk is that the entire system has become so intertwined that it's starting to look a lot less like the dot-com bust and a lot more like something far scarier.
As Phil Davis put it in October, this is not like the dot-com bubble. This is like the 2008 financial crisis. And why is that? Because the dot-com thing was about crazy valuations for individual companies, right? But 2008, that was about a systemic failure built on shady accounting and giant institutions that were all tied together.
And when you put them side by side, the parallels are, well, they're pretty unnerving. In 2008, you had inflated assets fueled by what they later just called bullshit accounting. In 2025, you have inflated valuations fueled by the great tech circle jerk. But in both situations, the real danger is this systemic interdependence, where a few too-big-to-fail companies are so tangled up that if one goes down, it could trigger a catastrophic chain reaction.
This right here, this is the textbook definition of systemic risk. It's not about one company going under, it's the risk of the entire system collapsing. And it's caused by exactly these things: interlinkages and interdependencies. The fates of NVIDIA, Microsoft, Amazon, they're not separate anymore. They're all woven together so tightly that one big failure could cause a cascading failure that brings the whole house of cards down.
So that leaves us with this one final, really unsettling question. You have an entire market being propped up by just a handful of companies, and a real economy being driven by only the wealthiest 10%. And the money fueling the whole thing seems to be flowing in a circle between the very companies getting valued. So is what we're all watching a genuine economic boom? Or is it a bubble of truly historic proportions that's just waiting for a pin?